I marked 20 order blocks on gold and only 38% worked. That's it. No secret settings. No complicated strategy. Just order blocks traded exactly how most traders use them. The surprising part wasn't the win rate. It was how convincing the losing setups looked. Some had clean structure breaks, some had strong displacement, some looked like the perfect screenshot you'd see online, and they still failed. So I started digging deeper. Same market, same time frame, same sessions, yet some order blocks held perfectly while others got run through immediately. There had to be a difference, so I went back through every trade and tested them one by one in replay mode without looking ahead, using the exact same entry and risk parameters every time. That's when one filter started standing out. The order blocks that had it consistently performed better. The ones that didn't were responsible for most of the losses. In this video, I'll show you the exact rules, the backtesting process, and the one filter that completely changed the results. Chart 1. Look at where price is trading. Nothing special at first glance, just a cluster of candles sitting near the lows. But watch what happens next. Price leaves this area with aggression, not a slow grind, not a hesitant push, a real expansion. Buyers take control and the market starts printing higher highs and higher lows. That's the clue. The order block isn't important because it's a colored box. It's important because this is where the move was born. Now watch the retest. Price travels all the way back into the zone. This is where most traders get nervous. They see the pullback and think the trend is over. Then the market shows its hand. Buyers step in immediately and reject the area. No prolonged battle. No deep acceptance below the zone. Just a clean reaction and continuation higher. That tells us the original demand was real. Entry comes from the mitigation of the block. Stop goes beneath the protected low. Target is the next pool of liquidity above. This is a high probability setup because the zone created the displacement and the market respected it again on return. Now compare that with chart 2. At first glance it looks similar. Price reacts around the highlighted area and many traders instantly label it a bearish order block. But slow down and watch the story unfold. Where is the displacement? Where is the aggressive selling that changed market structure? It isn't here. Price simply trades around the zone. It bounces, it stalls, it revisits the area repeatedly. That's not authority. That's indecision. The market was already showing weakness before reaching this level. The selling pressure existed elsewhere. This zone didn't create the move. It merely happened to sit in the path of the move. Now watch the retest. Price doesn't respect the area. It doesn't reject with force. It breaks through and continues lower. That's the giveaway. Real order blocks create moves. They don't just witness them. This is a low probability setup because traders are mistaking broken support for institutional selling. The zone failed because it never had control in the first place. Chart 3 is another trap that catches a lot of traders. The highlighted area looks important because price keeps reacting around it. Multiple touches, multiple pauses, multiple bounces. But that's exactly the problem. Strong order blocks usually don't need repeated validation. The market already knows what happened there. Watch how price behaves inside this zone. There's no explosive departure, no meaningful displacement, no clear shift in structure, just back and forth trading. Then eventually sellers take over and the floor collapses. Many traders look at the breakdown and think it confirms the order block. It actually does the opposite. The breakdown reveals that buyers were slowly losing control the entire time. This wasn't a launch pad. It was a temporary resting place. When the market finally moves away, the move originates elsewhere. That's why this is an invalid order block. The zone never demonstrated authority. It only delayed the inevitable. Now chart 4. This is where things get interesting. Before the rally begins, notice what price does below the lows. It reaches down and sweeps liquidity. Sellers become confident. Breakout traders jump in. Everything looks bearish for a moment. Then the trap closes. Buyers step in aggressively and price explodes higher. That's the signal. The liquidity sweep matters because it creates fuel for the reversal. The displacement matters because it proves commitment. The structure break matters because it shows control has changed hands. Now watch the return into the order block. This is the moment of truth. Price comes back into the zone and buyers defend it again. Not because the box is magical, but because the imbalance created there was never fully resolved. Entry comes from the retest. Stop goes beneath the swept liquidity. Target is the next major liquidity objective above. This is a high probability setup because every piece of evidence points to institutional accumulation before the expansion.